The global energy shock has rocked the world economy, but major actions by global players have granted a reprieve from the worst-case scenarios.
We can all be thankful the world did not take the war-driven oil shortage sitting down. A number of measures have staved off global economic crisis by curtailing consumption and making up for production and delivery when and where possible.
But if a lasting solution can't be found to the blockade at the Strait of Hormuz, it may prove impossible to hold back the rise in the price of oil.
A drawdown of strategic oil reserves has played a central role, tiding over supply as production has been blocked or destroyed. But reserves are nearly depleted and will run out sometime in July, at least by some estimations.
Is a global recession then an inevitable fate that we're looking at if this drags on?
Now, obviously, there are scenarios that you can point to where the Strait of Hormuz stays permanently closed, where oil prices go to some crazy high levels, and then you can get into really nasty scenarios for global growth and global financial stability. I don't think we're there yet.
Even if the war ended today, the world faces a reckoning with the mounting consequences of an irrevocably altered resource landscape it has no choice but to deal with.
It's worth bearing in mind that monetary policy in the United States, which is crucial in this discussion because it shapes risk appetite globally, monetary policy in the United States is not excessively loose at the moment.
So it's a bit rich to speak of a not excessively loose monetary policy shaping global risk appetite after so much productive capacity has been destroyed, with nearly daily fresh assaults on the national security or economy of nations worldwide. This framing boldly declares the Fed's dominion over dollar creation and circulation volume in the face of an administration spending billions into the economy every day, an unhinged financial sector, and a bond market that has lost its appetite for purchases. The Federal Reserve's economic effect depends on conditions it has major influence, but not mastery over. Interest rates influence the volume of dollars banks create. Buying or selling treasuries influences the volume of dollars in circulation. The Fed has absolutely no say in what the federal government spends into existence. Donald Trump is in control of that spigot, not least because Congress is his doormat, allowing him to spend dollars into existence on whatever he feels like in the form of obscene budgets, stuffing freshly minted dollars into his pockets and those of his crony orbit, while strangling the rest of us of any federal spend. And they let him get away with an undeclared war, now pouring $1 billion a day into the economy. Don't forget kiddies. Every check the Treasury writes adds dollars to non-federal sectors. History Corner. Just as with the flood of dollars injected into global financial markets as the U.S. spent money into existence conducting the Vietnam War, today's Niagara of dollars flooding into the economy is presenting the Fed with challenges it has limited capacity to respond to. Interest rates influence bank lending, but banks are the ultimate arbiter of bank money creation, because banks can only create loans if borrowers are demanding them, and banks will only offer loans if they convince themselves they won't be defaulted on. When a billionaire comes knocking at their door, they fall all over themselves, stuffing as much money into billionaire pockets as asked for. All that net worth is good collateral, right? The bond market controls how well the Fed can influence the volume of money in circulation, because the Fed's control depends on the price and the volume of bonds it can buy or sell. Right now, the bond market isn't buying bonds. All this, while fucking around with interest rates, has a cascade of downstream effects in existing conditions that are not particularly pleasant. You can't fix supply shocks with interest rates, but you can make things worse. I'd like to suggest the Federal Reserve's options are a little bit limited right now. Like it or not, Trump is hemorrhaging dollars into existence every day with no mop-up in sight. All of us could be taxed to death, but that doesn't amount to a drop in the bucket compared to all the money that's being spent directly into the pockets of the owners of Palantir, SpaceX, and Koch Industries. History is rhyming very hard right now on a lot of different levels. The dollars spent on the Vietnam War was the pivotal reason Bretton Woods collapsed. 2 years later, OPEC stopped the flow of oil to supporters of Israel's Yom Kippur War. When OPEC lifted the embargo 6 months later, the world was changed, not least because the single point of failure of imported oil had been exposed, but also because OPEC had finally wrested control over oil production from the oil companies that had dominated the world's oil reserves. The Seven Sisters had held the price of oil fixed over the 1960s, meaning that the price of oil had slid in real terms with respect to all forms of international domestic energy production, and led to the dependency on imported oil in the first place. The price of oil was 300% higher after the embargo, only to rise much higher later in the decade in consequence to revolution and war. The world had no option but to adapt to these realities. But I think, in real terms, the price of oil has again declined with respect to the price of everything else. Returning to contemporary events, China's suspension of 40% of oil imports has greatly contributed to minimizing the economic fallout of the war on Iran, at least so far. But, interestingly, they replaced oil in the production of naphtha with a liquefied coal produced domestically. It's more expensive, it's less efficient, but China decided to take this route. What we are seeing here is an example of necessity being the mother of adoption. In a world where fossil fuel resources have quite abruptly become very dear, nations around the world must think different because there is no choice but to.